Hi everyone, welcome back to another interesting video. Today, in the last episode, we covered the small finance bank universe in the country and we put out a framework in which we analyzed those banks. The framework basically covered five different parameters. First was valuation attractiveness, second was profitability of the product mix, third was the quality of the loan book and the collection efficiencies. Fourth was the capital availability and leverage, which is the ability to grow further without diluting any further equity. And last was the distribution efficiencies. Under the framework, we ranked all the listed small finance banks for these five parameters and then pulled out an average ranking. Now we will do the same exercise for all the listed private sector banks also of the country. The result we got from this exercise was very interesting. So look at the complete video to know more. So without much ado, let's get into it. We have a universe of 13 listed private sector banks in the country. Plus, I have added an AU small finance bank to the mix simply because it is now eligible to apply for a universal banking license, and I believe it's going to apply for it shortly. So, 13 listed private sector banks plus AU small finance banks, a total universe of 14 banks. The data we took out was the Q1 25 data based on June 2025 performance numbers and the valuation matrices, which is the price to book value and all, was as of 30th of August 2024. Let's quickly get into the data. The usual suspects, we believe ICICI Bank, HDFC, Axis, IndusInd, Kotak, these are all the usual suspects which are there in almost everyone's portfolio. But if you've got to invest in one private sector bank, how will I rank it is the video all about. So let's look at the numbers. It's on your screen right now. The largest market cap, of course, in the private sector space is HDFC Bank, followed by ICICI Bank. HDFC is a market cap of 12.5 lakh crores, ICICI Bank about 8.6 lakh crores. The third largest is way behind, which is Axis Bank at 3.64 lakh crores, and Kotak follows closely at 3.5 lakh crores. IndusInd is 1 lakh 10,000 crores, and everybody else is smaller, anywhere between 4,000 crore to a 50, 60, 70,000 crore number. So there is a vast difference between the top two, which is HDFC, ICICI, and the rest of the banks. Now, in terms of valuation, we picked out the price to book value. We simply went to Screener, took out the number as on 30th August 2024. Again, it was during the day. So maybe end of the day results and the price to book value might be a little different. But for the purposes of our study, it will not really make too much of a difference. The NIM gross NPA number were taken from the Q1 25 results, which all the banks have published, and find as a measure of the availability of capital, which is to grow its loan book without diluting any further capital. We use a matrix called ROE upon ROA, return on equity upon return on assets, which essentially gives us the leverage number. Lower the leverage, the better it is. So let's now quickly get into the ranking part of it. If you look at it, the best bank in terms of valuation today happens to be a DCB Bank, followed closely by Karnataka Bank. Now, these banks have a pretty low valuation for a reason, right? DCB Bank, which is the best on the basis of pure valuation number, which is price to book value, is laggard in almost every kind of business matrix which we measure, whether it is the NIM, it is ranked 12th out of 14. GNPA, it's 11th out of 14. ROE upon ROA, which is the leverage part, it's actually the last. And loan book per branch, which is the distribution efficiency, it is the last. So simply because a bank has a low valuation does not mean it's a good buy. It has to be a fair balance between the business performance and the valuation itself. Similarly, the bank which was the best in terms of let's say the loan quality, by which is denoted by the lowest GNPA number, was HDFC Bank. But again, on the valuation attractiveness, it is measured at it was ranked at a measly number 12. So it means that it is already very richly valued. In terms of NIM, the best bank was Bandhan Bank, but again, that was expected. Bandhan was predominantly into unsecured loans and microfinance loans. It is but natural that the margins will be higher. What's interesting to know is the second best profitable bank. Profitable is a wrong word. The bank with the second best NIM after Bandhan was IDFC Small Finance Bank. We ranked all the banks on all these parameters. Valuation parameter, we took price to book value again repeating the methodology. NIM reflects the profitability of the product mix of the bank, of the loan book of the bank. The more unsecured the book, the more granular the book, the better the NIM, hopefully. GNPA is the collection efficiency or the quality of the book. Better the quality, the better for the bank. Secured book, like a housing loan, will have a lower NPAs and collection issues compared to an unsecured book like a credit card and a personal loan. But again, margins in a secured loan are much lower compared to those in a personal loan and credit card. So as a bank, you have to do a fine balancing act between the kind of books you have and the kind of NPAs you are willing to take. The ability of the bank to grow without diluting further equity. It's denoted by a ratio called ROE upon ROA. The lower, the better. The best bank here is Kotak Bank, which has the best capital adequacy ratio amongst all the private sector banks. It is closely followed at number 2 by Bandhan Bank and number 3 by IndusInd Bank. Finally, distribution efficiencies, which is the loan book per branch. Now, this may not be the perfect measure because some banks have multiple distribution channels. Some bank might be very strong at online distribution. Some other bank may have a lot of direct selling agents or marketing agents or DSAs distributing their products. Some banks may work through business correspondents also. But with the limited information, this is what we took. Loan book per branch. Again, higher the loan book per branch, the better it is distributing its products, the better it is utilizing its assets, is what I believe. The better is the distribution. In the end, what we did was, there is one which is valuation, which is valuation attractiveness, which the market is assigning to the bank, and the balance 4 are performance related. It covers distribution efficiency. Once you have distributed a product, it also covers the product mix, which is essentially what kind of loans are you focusing on. NIMs reflect that. The kind of loans you're focusing on will give you the default ratio and the collection efficiency. If you're able to have a personal loan book with 22% returns and less than 1% NPA, fantastic, the best business to be in. So that will give us the GNPA. And finally, the leverage, that is how much you can grow your loan book without running out of capital. So all this, I took a simple average. It gave me a final ranking. When we balance out these all things, the business efficiency with the valuation number, what we are seeking is a bank with a pretty good business and which is available at a decent valuation. The bank which really came out of this analysis at the top was Kotak Mahindra Bank. It did very, very well in all the parameters, whether it's capital adequacy, it was the best. The distribution efficiency, it was the second best. GNPA, it was the second best, which indicates a very high quality loan book. NIM, it was in the top half at rank, came in at 5th out of 14 banks. But where it really lost out was the valuation. The market is already assigning it a premium valuation. Why? Simply because the business is so good. But when we balance the 5 parameters, it gives me a composite final ranking of 4.2, which means that if I've got to invest in one bank out of the universe of banks, then I will surely consider Kotak Mahindra Bank as one of them. The second bank with a final ranking of 5 was IDFC First Bank. It did pretty well in terms of the margins. It did pretty well in terms of distribution efficiencies. It was one of the best banks with the best distribution efficiency. It did okay in GNPA and valuation, and it really lost out on the leverage part. It has already leveraged itself, the capital adequacy. It will have to raise money to grow its book very fast. The capital adequacy is, is closer to the limits. So overall, the ranking was average rank was at 5. The second best was IDFC Bank, and the third best bank was an RBL Bank, which came in at a average ranking of 6. It did okay in terms of distribution. It did okay in terms of valuation wise. It's very attractive at this point. It is probably the third best attractive bank available in terms of price to book, third cheapest price to book in the listed space. NIMs, it is pretty okay in terms of 4. The product mix is pretty profitable for the bank. Where it did not do well is the loan quality. The book it has a very high ratio of defaults, and hence the loan quality was bad. Leverage wise, it was okay, somewhere in the middle, so it can still grow without raising capital next. Distribution efficiencies wise, also it was okay. So, what can you as an investor gain out of this? One, a bank which has a very decent business and is overlooked by the market is normally not the phenomena. If you ever get such a bank, then it's a no-brainer. It should be a part of your investment portfolio. Where the business is good, the market normally gives it a premium. Secondly, where the business is not so good, that is, the loan book is pretty bad, the collection efficiencies are an issue, then the banks will be available at an attractive valuation. Here, it's very important to go into a little more detail, read what the management is saying, read through the commentary, read how the NPA percentage is. For example, an RBL Bank, which did very bad in terms of the quality of the loan book or the collection efficiency, it ranked 10 out of 14. If it simply improves its collection efficiencies and reduces the gross NPA while keeping all the other parameters the same, the overall ranking will suddenly go up. So, what you need to consider and figure out from the quarterly results and the management commentary is whether the bank is working towards that or not. So if bank has identified its own issues where it is lacking and is working towards improving it, then it can be a part of your investment consideration and shortlist. So broadly, this is the ranking which we have. From the ranking, pure numbers, Kotak Mahindra Bank is the most attractive investment opportunity today. We should investigate further, followed by IDFC Bank and RBL Bank. ICICI Bank, HDFC Bank, Axis, IndusInd, all are somewhere in the middle. Banks which are not really doing good on any parameters are Federal Bank and probably DCB Bank. City Union and Karnataka are also doing not so well. So unless their performance improves dramatically, I would not look at it for further investigation. I would not even consider it for further investigation. Again, limitations of the study. These numbers are purely based on Q1 25 results. If Q2 25 results change dramatically, the rankings will change. So you have to follow up on these rankings consistently, update the data, maybe once a quarter, look at it, whether the bank is maintaining its position or not. It really is not taking into consideration how fast is the loan book growing, how fast is the bank growing. That is one parameter which I believe is missing from this. Also, what I am not considering here is if there is any kind of RBI action or any kind of external event which is affecting the bank. Is it that one large stakeholder is continuously selling its stake? Is it that the promoters of the bank are now exiting? Is it that RBI has some sort of an audit going on or some sort of a restriction going on? All those are not captured within this. So this list essentially is a shortlist, is a way to shortlist the bank's performance. And once you shortlist, you should do your further investigation into the numbers, the details, and then only decide on the final investment part. With that, we will close this video and we will come up with a video or a similar exercise on public sector banks shortly. Have a great day ahead. Bye-bye.